Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Ricus from PSG Hole and One Ruimsig and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. The JSE had a terrible time today, all share down more than 2%. There was a bloodbath in specific pockets of the market today, and most notably the retailers and the precious metals. Let's actually start off with that surprise update from TFG. Shane, such heavy movements to the red today on TFG. And it's quite interesting because when you started off seeing the sales figure, it was quite decent. It was almost 13%. But then you look and you see that is all white stuff. Did investors just look past the boost that white stuff actually provided for the company?
Well, Zanati, I think the issue here was not that the trading update was bad, it was that it was unexpectedly bad. And the management of TFG had recently engaged with large groups of institutional investors at their own capital markets day and at one of the global banks' conferences. And they did not communicate the extent to which the results would be as bad as what they announced today. Hence the surprise and hence the share falling at one point nearly 20%. I think the thing is that the company has grown largely by acquisition over the last decade, and the acquisitions have not driven results that have dropped through to the bottom line. So they have driven sales growth, but they haven't driven earnings growth. And the truth is that the TFG share is the same price it was 10 years ago. So despite growing revenue enormously, there hasn't been earnings growth. And so what they told us today was, that like-for-like revenues up 3, 4, 5%, but earnings are going to be down 25. So that alarmed investors, and I think it has made people question, is this acquisitive strategy working or not?
That's actually a very interesting point that you make there, Shane, because it wasn't just TFG that was growing by acquisition, Mr. Price as well. And I'm wondering if this is also a case of, investors not being sure if this acquisition strategy is working out for TFG, but also a question of comparing TFG then to its counters at this point, like Mr. Price. Ricus?
Yeah, I think against the backdrop of consumer spending that's under pressure, and I think the Truworth results released a few weeks ago was sort of maybe a little red flag, pointing to what the stress areas are in consumer sectors. And if you've been growing by acquisition and your increase in revenue is not flowing through down to your earnings, it means that your margins are under pressure, which means that your acquisitions aren't really doing the job that they're supposed to be doing. And as Sean just said, with TFG specifically, it's taking longer and it's not fulfilling the market expectations. And I'm not sure what Mr. Price is going to look like, but it certainly is a warning sign.
Yeah.
If your acquisitions are not working because your economy is not working, what are you left with? You're left with margins under pressure.
And it's actually quite... Yes, Shane?
No, I was just going to say, one of the reasons that these companies are doing acquisitions is because the economy is not growing, right? if the economy was growing 3-4%, then there would not be the need to do acquisitions. Having said that, the acquisitions, in the case of TFG, don't appear to be delivering the earnings, even if they're delivering the revenue. And then the other problem with acquisitions in general for companies is it creates a lot of difficulty in looking at the results in a comparable way, because the company never looks the same in any one year. And that difficulty in analysis tends to make investors give companies that grow by acquisition a lower rating, because there's a higher degree of risk and a lower level of investors' ability to interpret what's really going on.
Yeah, and I was actually going to say it's quite interesting because, I mean, just from a consumer point of view, a layman, I look at Foschini, the actual store, and there's actually a lot of footfall there. So it would be quite interesting to also just go through the breakdown of the different stores. But also, I guess it really also points to that, as much as the core store Foschini is, you know, has a lot of footfall, but what about the other stores that you have acquired along the way? Ricus, you mentioned the red flag that we got from Truworths and of course, the stress areas when it comes to consumers in South Africa and the economy. But a lot of people have been picking Pepco within that space. Do you think Pepco is then maybe insulated a little bit from some of these stresses?
I'm talking my book, and I hope so, because that has been and still remains my favorite consumer stock in that space specifically, because they are. They've also been acquiring things, but they are diversifying the income stream away from just clothing and into the finance sector, which I think is quite interesting for them. They've got to look after their debtors book. But again, if they can maintain margins, as long as they can grow revenue, as long as they can manage their debtors book, those three positive things does lead to an increase in cash flow, which in the end is what I'm interested in.
Okay, very fascinating. All right, gents, another bloodbath that we saw was in PGMs today, and Valterra was one of the victims. There's a question here that says, I want to sell my Valterra shares and buy PSG Financial Services. Is this a wise decision? And then also, they're asking, how much does the panel think will the share price of PSG Financial Services will be at the end of 2027? As much as Ricus, you work for PSG, I also don't think you can predict what the share is going to be by the end of 2027. But let's start off with you, Shane. A very interesting switch that the viewer wants from Valterra to PSG Financial Services. Would that be wise?
Well, look, obviously you're switching out of a resources company, a precious metal company, into a financial services business. That's you're getting very different exposure. What I would say about PSG Financial Services is that it is run by Francois Gous, and he is one of the most competent executives in South Africa. He runs the business in a very organized and disciplined and systematic way, and he's done an extremely good job managing it. I would characterize PSG Financial Services maybe as in the top 10 or 20 best managed businesses in South Africa. That's not to say that it's going to outperform Valterra, because it's just completely different exposure. Valterra was down 10% today, but it's still up, let's say, I don't know, 150% over the last 12 months.
Yeah.
So, you know, it's very different kind of exposure that you're doing. And, you know, if you had to own both, that would be a very kind of typical of what we call a barbell portfolio, where you're getting a little bit of both. Where the companies are similar is that Valterra is undoubtedly the best PGM company in the world. So, you know, if you want to be in PGMs and you want quality, that's probably the one to be in.
And actually, it's quite interesting that the viewer is asking about selling Valterra shares, when we saw that big downward drop today. But I mean, just really putting it into context, Shane mentioned that these counters are up so much that I guess even this plunge today doesn't really compare to how much they've gone up. Selling Valterra shares at this point, Ricus?
It depends, and that sounds as if I'm sitting on the fence, but it really depends on what your exposure is. If it's um, a manageable bit of your total investment, not more than 5 or 6% of your portfolio, and you can stomach this kind of volatility, which you should if you're used to the kind of moves we can get in precious metals mining stocks, then 10% in one day. I mean, it's headline news, but it's not a disaster. Today's price is equal to where it was about a month ago. And as Shane said, those counters have doubled in the past 12 months, or, up 50% or whatever. So there will be these kind of swings. So you've really got to take a look and say, so what has caused this drop? Obviously, gold and platinum are down quite severely today. I think gold's about 6 or 7% down.
Yeah.
That's a huge drop historically, but not when you compare it to how far it's come this year. And is there any specific news that has caused this drop in gold? Not that I know of. And specifically, if gold and or platinum are fear metals, in other words, things that do well when global geopolitical news is not that good, then it should actually be going up, because ceasefire in the Middle East is not holding. We're not seeing a conference between Putin and Trump. Things that have actually sort of boosted or levered down geopolitical concerns over the past week. All those things have blown up. So it's actually bad news. They should actually be going up. So I wouldn't really panic just because of a one-day drop.
Okay.
But still have stop losses in place.
Okay, interesting. Interesting that you say you wouldn't panic, especially on gold, Ricus, because the next question then that I'm going to ask you, Shane, is the viewer says, as a medium-term investor in my golden years, should I consider gold at this stage? And if so, what is the best company to invest in?
Zanati, the way that we look at shares at All Weather is to say, what is the sort of the short-term trend, let's call it the seasonal trend, and then what is the long-term trend, let's call that the secular trend.
Yeah.
And I think it's very evident that the secular trend for gold is upwards, irrespective of whether the ceasefire in Gaza holds or they resolve the war in the Ukraine. The reality is that there's an active policy run by the United States government to reduce the value of the dollar, essentially to debase the currency. And on top of that, of course, there's the dismantling of the global alliance systems that they've had. But I think the secular trends for gold are very strong. So notwithstanding the fact that gold has, let's say, doubled in the last 12 months, I would think that, if we had to be talking to each other in 2 years' time, the gold price is likely to be higher, not lower. What it will be in 2 weeks' time is hard to know.
Okay, very interesting. Right, more questions for you, gents. Any reason, technically or fundamentally, not to buy Rainet? Sale of pension fund should be concluded early 2026, and NAV is close to 750 per share from what I read. Not sure why the stock is not trading much higher. Please guide me. Ricus.
Maybe Shane knows more about it, but I think just from my perspective is if that sale does get concluded, the uncertainty remains as to what's going to happen then. And markets don't like uncertainty, and I think that, to me at least, explains that discount.
Shane, I would have thought that the stock has re-rated a little bit after the announcement of the sale of the pension fund asset. So just talk to us about that, why it's not trading higher at this point, because I did see actually a huge downward movement there. But also another viewer is asking, is there a potential special situation with Rainet? I guess that's maybe what everybody's waiting for at this point.
So, Nati, I mean, look, of course, this is undoubtedly a special situation. I would say that this is close to, it's among the best ideas I can see on the JSE at the moment. The share's trading at 500 Rand. They have cash of 600 Rand and the NAV is 740 Rand. and the money that they do have is in hard currency. It's either in sterling or in euros. So, yeah, I'm saying to you, look, there's an asset worth R7 and you can buy it for 5, and most of the NAV is cash. As Ricus says, there is some uncertainty over what happens, but I think it's likely but not certain that the company will be wound up and there will be some kind of offer to minorities, not at full value, but at some version of that within the next 12 months. The great thing about Reinet is it's a low risk situation to play. This is not like buying a gold share. This is a great company whose assets are cash at a big discount.
If I remember correctly, Shane, you're comfortable with both Reinet and Remgro, because the next part of that question is, do you think Remgro is better to own since it is also trading way below NAV per share?
So look, I mean, these companies are cousins. They came out of the same group, I think probably 20 years ago. And Reinet is named after Graaf Reinet, where Johan Rupert was born. And Remgro is the collection of the South African assets, and the business is trading at about a 45% discount in net asset value. Now, that is not a cash business. The assets are not cash.
Yeah.
They own very good quality companies like Discovery and Outsurance and some unlisted assets. But I think they're both extremely good ideas. In fact, in the all-weather hedge fund, they are the number 1 and number 2 positions, because I think we do live in slightly risky times, and these are good quality assets at significant discount to the underlying NAV.
Ricus, would you be going either or on Reinet and Remgro?
I have Remgros in my accounts for exactly the same reason Shane has just mentioned. And he makes, and again, Shane makes a very good case for Reinet as a low risk, possibly not spectacular, but decent return considering the general state of the market. So yeah, I'm very happy with Remgro and Reinet. If you want to do that waiting game, I'm fine with that as well.
Okay, very interesting question going into the food production space. Why not short AVI? Shane, I don't know. This is in a time when everybody's buying into the food producers.
So you're right. I mean, there's been some corporate activity in the food sector. There have been 2 delistings of food companies. I mean, remember, there was some proposed corporate activity around AVI where an American multinational was looking to buy them out 2 or 3 years ago. But to answer the viewer's question, the reason not to short AVI is it is run by one of the most competent CEOs on the JSE. I mean, I mentioned Francois has been an excellent CEO. Equally good is Simon Crutchley that runs AVI. And the JSE is not blessed with multitudes of great CEOs. These just happen that what we're discussing to be 2 of the very, very best. This is like the horse and the jockey. And these are 2 good jockeys, and there are not many good jockeys in our world. So if you want to short a company, rather go and find a company that does not have good management. AVI's got excellent management.
Well, I'm also going to come to a company also which does have good management, and that is Afrimat, a question that just came through right now. But in terms of AVI, Ricus, I think you were on Stockwatch on the day of the corporate action between Premier and Rhodes. I can't remember which one you picked, but would AVI be on your radar if you didn't pick it?
No, AVI was my stock pick on that day, and part of that was that sector in general, which I think is in Bible territory, and to me the fact that Premier made a bid for Road Foods tells you that Premier, which is run by as good a management company, sees value in that sector, specifically with Road Foods, and who am I to argue against that?
Okay, all right. Well, let's get into Afrimat. Should I buy Afrimat now before the results announcements on Thursday? I think that stock has done a little bit of a recovery, if I'm not mistaken, Shane. But would this be something that you're finding opportunity in at the moment?
Zanati, I would say no, for the reason that Afrimat's a 5-6 billion market cap. It's a smallish business. It's quite reliant on a small group of very competent management, and there are many better opportunities, in my opinion, in larger, more liquid counters. You know, if if the situation was that, let's say, the South African banks were trading at 2-3 times book value, on P's of 15 plus, as they have in the past, then I would say go into small caps. But you can buy a Nedbank on below book value and 8 or 9% dividend yield. You can buy ABSA also below book value on a 6% dividend yield and probably a 15% annualized growth over the next 2 years. So why would you want to stray into small caps when you can buy large caps cheaper?
Okay, seeing better opportunity. And actually, yeah, I think that recovery that I was talking about was very short-lived and it was for a very short period of time. Ricus, how would you be approaching Afrimat at this point?
Yeah, no, I'm keeping a watch on it, but let's face it, its underlying business is under strain, not because they're being badly managed, but because they have to execute those business, whether it be cement or anthracite or coal or whatever. They have to execute turnarounds and management in that business in circumstances which is not good for them. I mean, that cycle hasn't turned yet, and if the cycle in the underlying market is not turning, the share price earnings are not going to turn around. So I've got full confidence in management, but I don't have confidence in the markets that they're operating.
All right. There is one more question, but we are kind of tight for time. Let me see. Let me get to your stock picks first and see if we will have enough time for this one question. But if not, that question will roll on over to tomorrow's Stock Watch. So let's get to your stock picks, gents. Shane, what are you choosing today?
Zanati, I'm going for Truworths, which was down 3% today. And the reason, I'll give you two good reasons. The first is that the South African long bond yield has rallied from 11% to under 9% over the last 12 months. That should be the inverse of the Truworths PE. The Truworths PE should have gone up, and actually it's gone down, let's say from 9 or 10 to 7. So the share is extremely cheap, despite the fact that the long bond has moved in the opposite direction. And then I would say management. I think that Michael Mark is among the most trustworthy of all the chief executives on the JSE. I don't think that he's immune to what goes on around him. I mean, we know the economy is not growing, but at the end of the day, one of the most important things we believe at All Weather is you must invest with management that you trust. And if you don't trust the jockey, just don't do it. And I think he's a very trustworthy person.
All right, very interesting take there. Well, let's get to your stock pick for today, Ricus. Where are you finding value?
LVMH, luxury. I've been going on about Richmond for a while and thinking that's about. I think LVMH in the same sector also has potential. Unlike Richmond, it's got a broader product base, from handbags down to sparkling wine, or as my wife said, baubles and bags and bubbles. So in that sense, they are not as dependent on one specific sector like Richmond, for example. Plus, the company itself has been under pressure ever since COVID, basically. But we are seeing signs of a turnaround in revenue. And as I've said, free cash flow depends on three things: margins, revenue, and how you handle your debtors and creditors book. So if we can get a revenue increase, and I think that's what it looks like, as if you've got a turnaround in that, their margins are fine. It's going to drop down to cash flow and earnings, and at current prices, also just from a technical aspect, looking at a graph, it does look as if it's got a turnaround situation going with at least a 15-20% price upside.
Just lastly, Ricus, I'm quite interested in this kind of recovery that you're seeing in LVMH and I guess the general luxury stock market, because those are tied to what's happening in China. Is that also meaning that there is some sort of optimism coming through in terms of how China's economy will filter through to these companies?
China is important, but in the case of LVMH, they're far more geographically spread than just dependent on China. So don't forget Europe. Don't forget South America. Don't forget developing markets apart from China. Don't forget Europe itself.
All right. Well, thank you so much for your time and for your analysis today, gents. And thank you for educating us. That is all for tonight's Stock Watch. Thanks to our guests, Ricus from PSG Hole in One Ruimsig and Shane Watkins from All Weather Capital. Up next, the close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.